Hello, and welcome to our Banking on Relationship Capital presentation. In the world of financial industries, you'll hear all about the tech and the platforms that make transformation possible. At Zennify, and in this presentation, we'll show you how to bring that possibility to life. While we take deep dives into the platforms like Financial Services Cloud, Data 360, Marketing Cloud, and beyond, the reality is that they're just the beginning. Our goal today is to look beyond the platforms to drive real relationships and real results. My name is Lauren Slen. I'm a principal consultant at Zennify. I bring over 20 years of experience in the financial industry across retail, wealth, and commercial banking. I specialize in large-scale transformations, and I am passionate about governance models and change management to support those large-scale implementations. I'm joined today by James Leibowitz, an account manager with RelPro. James, would you like to take a moment to introduce yourself?
Yeah, thank you, Lauren. James Leibowitz, account manager at RelPro. I manage some of our largest banking partnerships across commercial, business banking, private banking, helping to drive new business and client growth through internal and third-party data.
Awesome. Glad to have you here today, James. So let's jump in. Today, we're going to be discussing the what, how, and why of relationship capital. The question is, what is it and how can we bank on it? So we'll be discussing the methodology, best practices, and James and I even have some real life client examples to share along the way. So in banking, C-suite execs will point to deposits, assets on management, retention, acquisition as the ultimate metrics. And of course, they are. But the reality is that they're lagging indicators. The true leading indicator of success is time, the time our advisors spend with their clients. And it's what they do with that time that determines whether they're building or eroding relationship capital, and ultimately the bottom line. So today we're going to look at relationship capital in two different ways: the core pillars of relationship capital and the platforms that drive it. So at its core, relationship capital is made up of four pillars. Trust, the foundation of every relationship. You can't begin to drive a deeper relationship with your clients or truly anyone without trust at the core. Advocacy, cultivating champions and loyalty within your immediate client network. Centers of influence. So looking beyond our direct clients, looking to your network, your community, and reaching out for further opportunities and referrals. And last but certainly not least, and probably where we're going to be spending our most amount of time, is data-powered engagement. That's really the sweet sauce to how you take a strong relationship and continue to drive it and deepen it across that client relationship lifecycle. In order to power those pillars, strategic platform investment is critical. Now, this image here is intentionally designed as a ladder to climb, although what I find with most clients is it's not often followed in that linear fashion. Quite often than not, organizations will have made a targeted investment, whether it be in Financial Services Cloud or Marketing Cloud, and then they look sort of to that bottom fashion around their data lakes, data core, and onto Data 360 and beyond. So the takeaway from this is to ensure that as your platform investment grows, your data maturity deepens. And that's really where relationship capital can come to life. And the proof is in the numbers. So research shows that banks that invest in relationship capital see a 30% higher client retention rate. And I think we all know that acquiring new clients versus retaining our existing is significantly more expensive. So if you can drive that type of retention, that's a pretty big deal. We also see that banks that embed intent signals, which James and I are going to get more into here, into their processes, shorten sales cycles by 25% and increase closure rates by over 40%. And it's all about simple, targeted insights at the right moment. So, James, with your experience at RelPro, do these numbers hold up?
Yeah, and as you said, buyer intent data is certainly one of the data sets, primarily the main one this year for us that's driving ROI numbers such as those. So intent's telling us what specific products, services, bank names, business executives are searching for online right now. And this has been used for new business growth and client engagement by banks, where on the new business side, you can see the prospects within your footprint searching for products and services you're trying to push out into the market online right now. And on the client engagement side, understanding across your book of business which of your clients are looking at specific intent topics so that at the right time you can focus on client retention, cross-selling, upselling, etc. So next, what I want to talk about is a top 100 US bank that we partner with. Now, historically, they were sending email campaigns and receiving about a 2 to 3% hit rate. When they started to leverage buyer intent signals into that process, that 2 to 3% jumped to 50%. And the big reasons for that is buyer intent really eliminates the guessing game of when is the right time to reach out to a prospect or client. What should your talk track be on? And having the right talk track will make you show up as that trusted advisor as well.
That's pretty powerful. What a significant jump to see in their activity. And like you said, it's all about the right information at the right time, right?
Yeah.
And that's really where we start to see the shift from reactive service to proactive engagement, right? When we're looking to scale trust and not just those pure transactions. So that really brings us to the next topic around the relationship maturity curve. So as we share the stages across this maturity curve, I want everyone watching to really think about where they're at and also where their organization is at. Because, of course, across your org, there may also be some variation in this. So, when we look at this relationship maturity curve and putting it in context with the example that you just gave there, James, is that top bank was likely in the earlier stages of this relationship maturity curve. They were likely transactional and siloed, or maybe they had some foundational pieces pulled together. But the reality is they're not using intent data. They likely have fragmented data sources, little client visibility, and they're missing really those key moments to connect in with their client. And as we move through the relationship maturity curve, you start to see that we start to bake in more of that relationship visibility and signals. We start to understand how and where and why our clients are interacting with us. And that's really where we can move to that proactive insight, surfacing timely AI nudges to our bankers or even direct to our clients in order to drive that automated and scalable relationship insight. So the key here on this relationship maturity curve is to remember that the data is the relationship, and the relationship is enabled through your tech investments.
Yeah, that's really step one. And if you wouldn't mind going back for a second, Lauren, I just also want to chime into transactional siloed data. You don't want bankers spending an hour researching for a prospect or client meeting just to come up short at the end of the day. There's a top 5 US bank that we surveyed about 5 years or so ago, and they found that when having aggregated third-party data at their fingertips, their bankers would save 15 to 20 minutes per prospect. So to your point, to that point, you have to have number one down, the full data picture all the way up to the number 5 on this curve, leading to automation, AI workflows, et cetera. So with that, once you have that data part down, I want to talk about some automation that we've seen. This same bank leverages what's called executive role change alerts in their CRM. When a key executive at a prospect or client company changes positions, Salesforce is automatically notified so bankers have that heads up. So to walk through an example here, let's say that Sally is a CFO at an existing client company in your Salesforce. If one day Sally decides to leave that existing client company and join a new business, a couple things will happen inside your CRM. Number one, the data is going to get updated automatically for you. Number two, bankers are going to see this and proactively reach out to Sally at the right time, congratulating her on that new position and bringing a new business into the bank. At the same time, this is also a chain reaction. So Sally has joined a new business, but her old position is now up for grabs. So when someone is promoted or hired into that CFO role, there's another notification that goes out giving the banker or that RM a heads up that CFO position has been filled. Reach out to John, the new CFO, at the right time to start being their trusted advisor. The big takeaways here is when you have this sort of automation, these alerts coming in, you're freeing up your banker's time to go out and do this research. You're also driving CRM adoption, increase in usage, because bankers are getting this data at their fingertips, and this is data that they want to work off of to go to market. And lastly, really just allowing this data to happen in real time as well.
I mean, that's the secret sauce, right? That's what's so powerful about this is, I don't think that there's a bank that I've interacted with that wants to add more FTE, more bankers to their workforce in order to reach more clients. We're asking our bankers to do more with the time that they have. And so, to your point, if they're navigating around siloed data systems, or if they're not getting these nudges of things that happen and they actually have to go and research it themselves or take a deeper dive into that client profile, that's eating up valuable time that they could be spending in front of their clients, right? So far we've talked about the what and the why of relationship capital. So let's take a shift now to the how. Like I just said, the reality is as our bankers are bogged down with desperate platforms and siloed data, but as our platform maturity grows, the orchestration of relationship can occur. So let's take a look under the hood. Now, when we look at the left-hand side of this image, we're taking a look at what are those signal data sources and where might they come from? And so it can be everything from transactional behavior. Are we seeing differences in deposits or withdrawals or selling of stocks, whatever that might potentially look like, all the way through to how our clients are navigating our online website, what they're clicking on, how they're interacting with us. And so all of those signal data sources pulled together and pushed through our engagement orchestration of Data 360 is when we can really start to harmonize and segment and prepare all of that great data for then activation. And that's through RelPro, through Agentforce, and that can be then pushed directly to our bankers, as you mentioned in your example there, James, so that they've got smarter and more timely outreach, or it can even fuel our client journeys through Marketing Cloud so that we're making relevant and timely recommendations to our clients in a D2C sort of fashion. And while all of this is happening under the hood, this is what we start to see and how to measure our progress on the surface. So again, relationship capital can feel like a big fluffy term, but this is really about how do we measure it and how do we build scalable growth within the confines of relationship capital. So again, we've talked a few times here around advisor capacity gained. And so this is critical. We need to have data really pulled together and aligned, and we need to have process health really optimized. And so that's through tech investments, but it also seems to show up in process health, cycle time, automation rate, and client coverage ratio. When you're able to actually match that and power that with those proactive intent and behavioral signals, that's when the magic of relationship capital really comes into play. And so again, the proactive intent and behavioral insights can be measured through the amount of insight or intent signal surfaced, next best action adoption, signal to engagement rate, and signal driven conversation. And that's really where the magic of relationship capital occurs. That's where we can start to see deepened relationships, growth of wallet share, and driving acquisition and reduction of attrition. And so, again, this is really to help break down when we talk to our executives about relationship capital, that it's not this sort of pie in the sky soft skill or soft metric that we're trying to drive. This actually shows how we can very strategically layer this back to a tactical implementation in order to get us through to measurable relationship capital and really something that becomes your organization's greatest asset. So take, for example, this Zennify client that I'm working really closely with. We took time while we were doing a technical implementation to pull ourselves back and not just look at the tech that we were about to optimize or put into the hands of their end users. We wanted to take a look at their ultimate strategic goal. And this is one of my favorite exercises to do with clients is around value tree. And so we defined through work around their strategic goals that the ultimate driver for our project was going to be to deepen relationships, to accelerate growth and maximize share of wallet, which AKA is relationship capital. And so, very similarly to how we broke down the KPIs of how you make relationship capital a tactical and measurable practice, we took that strategic goal and we broke it down across primary objectives. So, in order to make that true, we needed to find operational efficiency and we needed to drive client data and insights. So, again, that sounds a whole lot like capacity and data and insights. Then we broke it down into our value drivers. So different functionality and capabilities that we wanted to turn on in order to make those happen. And then along the bottom there, the key tech implementations that needed to occur, or in this case, potentially tied together in order to make it all happen. And so really, this is just that diamond, if you will, pulled into more of a linear and methodological steps that we needed to take. So investing in the right foundation, activation of insights, empowering our advisors, and then of course, measuring of those outcomes. So James, I'd love to hear more about client success at RelPro and some real life examples that you have.
Sure. I think the biggest theme, we're trying to hit on here is the insights, the real-time intelligence. And I want to talk a little bit more about automation. So we mentioned buyer intent signals. We mentioned the bank that does executive role change alerts in their CRMs. There's other types of signals, triggers, alerts that we've been seeing recently. One being the M&A activity this year. There's been a huge uptick in mergers across community and regional banks in the second half of this year. And a lot of banks are using this as a signal to say that if one of my competitors in my market, whether they're a community or a regional bank, is going through a merger, this is a real-time insight for me to identify, call on some of that competitor's clients because they may go through a period of disruption due to this M&A activity. On a similar thread too, another type of signal we've seen is when you have the data and the knowledge on when filings and loans in your market are coming up for due or coming up for maturity or a refi opportunity with a competitor in your backyard, that's a great time to engage them because you may miss out on the opportunity to get them at the right time without that expiration date, for instance. Now, the last one I want to mention is around news feeds. We've seen banks do a great job capturing when their clients and prospects are mentioned in the news and have good automation around this so that bankers can proactively reach out to their prospect or client and congratulate them for, let's say, opening up a new location or hiring someone new in their C-suite. So again, they show up as this trusted advisor. So when you figured out stage one, you have efficiency, automation, AI in play. That's going to allow up more time for your bankers to prospect, go to market, engage with clients, and then coming down to the bottom here has a better chance of increasing deals and wallet share opportunities. And that leads me to my next point. When the automation is figured out, bankers have the time to start going to market. Here's a case study that we did earlier this year with a top 50 bank and a CNI banker. This is a banker that had the time again to prospect, but was based in a large metro, had multiple industry verticals, was really capturing all types of sale sizes for companies and found himself uh, pretty much at a standstill where there were thousands of companies within his total addressable market, but didn't know where to start, who to call on today, and who to prioritize down the road. So this banker started to leverage buyer intent signals and filings and loans research to get a lot more qualified than quantified, where he said, show me the prospects in my market that are looking at C&I products and services that I'm trying to push out. And which of those prospects have filings and loans coming up for maturity with competitors. So when you start to layer in these signals and triggers, for this banker in particularly, they started with thousands of companies and drilled into just a handful. With timely outreach, they called on a handful of those businesses, got into the door with many of them, and closed a $3.3 million deal with one company on there. And what I love about this is multiple lines of businesses were reached, and these were some of the intent topics that they were searching. There was a working capital line, new deposits, TM fees, and an introduction to the wealth side of the house.
I mean, talk about taking a banker from what sounded like almost data overload and paralysis to actionable and timely behavior. Hey,
Yeah,
yeah, that's pretty awesome. And so really, I think what we're seeing and you know, there's a lot of common threads between the stories that we're telling here, James, is that organizations that are investing in relationship capital are focusing really on three critical elements. They're cutting through the data overload to ensure that bankers aren't having to go to multiple different systems and do in-depth research and analysis on their accounts. So we're pulling all of that together and surfacing timely insights to help them really focus in on the best conversations at the right time. But what they're not doing is taking a step back from human connection. So I think any of the examples that we've given have all really focused around the human at the center. They're just really being powered by the data and insights and the capacity we're freeing up with the right technical purchases in order to drive that human connection further. And then with those two things in motion, we're really starting to see that amplified engagement. So this really becomes 1 + 1 =, and it's not just two; it's infinity in terms of the opportunity and engagement that they can have with their portfolios and with their community. And so, you know, as today we've discussed the what, why, and how of relationship capital, I hope it's become clear to folks that this isn't just a soft, fluffy term, that it is something that can equal measurable equity, that investment decisions and the efficiencies gained from that, plus the intent data and timely recommendations can have direct results to growth in capacity. And embedding those insights ensures sustainable and scalable success. And as we look ahead, I see more and more organizations looking to relationship capital as a critical KPI for growth. James, final thoughts on your end?
yeah. Just to wrap up, I think it's really important to understand why CRM quality data is crucial here, starting with AI initiatives. So AI is only as good as the data that it uses, garbage in, garbage out. You want to have a reliable picture of your prospects, clients, automation to fuel a reliable AI engine. Next, when it comes to a couple of things here, so CRM engagement, ROI, business growth, having this up-to-date picture of everything filled out on the prospect and client level will allow your management leadership teams to see where the true opportunities lie in the market. If it is not in Salesforce, it did not happen. And then lastly here, just for banker efficiency and a final wrap up, having this up-to-date picture of your prospects, clients, automation through internal and third-party data allows your bankers to spend less time researching and more time building relationships, going to market, prospecting to drive wallet share.
And I think all of that really sums it up beautifully, right? This is about the tech investments that you make as an organization, but it is about driving usage and adoption of those tools, because you can make all of the right tech investments and provide all of the right features and functionality, but if your workforce isn't leveraging it, or leveraging it in the right way, right, with the data that you've indicated, then you're sort of at a standstill in terms of the insights and data that we want to drive. But if you can get all of those things right, then there really is magic to happen in terms of client relationships. And so really with that, I want to close it off with a sentiment that I hope everyone carries into their future investments and strategies, is that the future of banking belongs to those who use data to humanize and not dehumanize client relationships. Thank you so much for joining us today.